Hey everyone, this is Kirk here again at OptionAlpha.com, and thanks so much for checking out tonight's video tutorial where we go over all of our opening and closing or adjusting trades. Now today we actually had a pretty active day in the market, and on Monday we only had one trade, and that was the vertical in FSLR or First Solar. So we're going to cover that one in the video tonight just because we didn't want to waste a whole video on just one small credit debit spread in First Solar. But we were very active today, a lot of new positions, a lot of hedges that we either got out of and entered into, including the RUT roll, which was generated a lot of comments and questions on the blog, so I want to go over that one, as well as the hedge in SPY, which was a little unorthodox because it was a little bit wider hedge. So we actually took in a little bit bigger position in SPY, but I'll show you guys tonight why we did that and how we're kind of positioned going forward with the hedge in SPY against our current call spread. So before we do that, let's go ahead and go over some of the opening trades first, and then we'll get into the SPY and RUT together, those rolls at the end of the video. So the first one I want to go over obviously is the roll from Monday. So Monday we had a new open order for Monday, and that was for solar. So we got into the July options, the 67.5 call spread, and we got into that for a net price of about 260. So a little bit over mid price. It's about a $5 wide spread, so we want to get into those for about $2.50. Pretty much one of our typical debit spreads that we do with the market, and really what we wanted was just some positive delta in our portfolio, and wouldn't you know it, but First Solar was one of those ones that was actually down today when the rest of the market was up. So go figure, but at least the stock has been pretty resilient going forward. So hopefully over the next month and a half, we've got a lot of time here. So our break-even point is pretty much right about here all the way through June expiration and into July expiration. So we're definitely going to be holding this for a long time and seeing what we can get out of First Solar in the next coming weeks. But again, just more of a directional trade to keep active in the market. The next trade that we entered was CVS, and this is actually a trade that I entered while I was on a coaching call this morning with one of the premium coaching students. And it was more of a directional trade in that we, again, needed some more positive delta in our portfolio, getting a little bit more bullish as the market continues to break into new highs. And it was a good tutorial for him on calendar spreads because we were looking at debit spreads versus calendar spreads. And as we kind of looked at this trade in CVS, the debit spread really didn't make sense. And the reason it didn't make sense is because of where CVS's options were trading, in that you couldn't really get an option price that gave you a break even very close to the actual underlying price of the security. So we were trying to trade everything from the 80 to the 80.5 call spread to the 85. Just nothing was really working, wouldn't really give us that good break even point. So we decided to switch over and do a calendar spread. And now we're focusing on the July-June, yes, June, so it only gives us about 15 days, so it's a little bit shorter time frame of a trade. But we are doing the July-June calendar spread at an 80 call. Now we paid a little bit more for the spread, but that's okay. This is a slow-moving stock, so we paid about 44 cents in debit. And again, since our front month option is June, that's ideally when we want to close out the position, is in June. So if we go to CVS, you can see again, it's just a very slow but very steady moving stock. So hopefully we continue to see a move higher in the stock. But we really kind of pinned everything right around 80, which is just above the screen here. You can barely see it, but right above 80, that's where ideally we want the stock to go between now and June expiration. So we've given ourselves a little bit of time, and hopefully CVS is a slow enough mover that it will move that high. Now it's already started to move in that direction today since we entered that order in the morning. And so we already have a nice little profit, but you can see here on our profit loss diagram that this is that nice shape of the calendar spread that we have here, kind of that peak right around 80. So that's exactly where we want the strike to go. But if the stock continues to move higher and higher and higher, we'll likely close it out as it gets towards 80 before expiration, just because anything can happen in those last couple of days, and we don't want it to go outside of that boundary. But right now we have a nice little profit in CVS, and again, it's just a trade to keep us active directionally in the market. All right, so let's go over the closing trade of TLT before we get into the hedges. So one of the trades that we closed out today was our diagonal in TLT, and this is actually a good segue into diagonals from calendars, because as I was explaining the other night on coaching, is that a diagonal is nothing more than a debit spread married up with a calls or a calendar spread. So you're doing the same thing that you would do on a debit spread. So forget the June, July options here, but you're buying a 111, 110 put spread. So you're making that directional bet in the market. So in this case, we made an original directional bet that TLT would go down. So we bought the 111, 110 put spread. But in addition to that, we also paired that with an iron or with a calendar. So we spread those two different strikes out over 2 different months. So buying the July and selling the June. So selling that front month option. And it gives you a profit loss diagram that's very, very similar to a debit spread, but it has that kind of peak right around where the short strike is, similar to a calendar spread. So check it out on the website. We've got a lot of video tutorials about diagonals. But in this case, we were just really, really short bonds and wanted TLT to go lower and general bonds to go lower as well. And we got a nice little move, and this wasn't a huge move that we were expecting anyway, but we went ahead and sold back to the market the diagonal that we bought for a 102 credit. So it took in a nice $40 profit on the whole trade overall. All right, the other trade that we got out of today is Zynga, and Zynga is a really interesting one because we actually came a little bit close to the market when we actually entered the order, and that was so we could get our 30-cent premium that we were looking for. And ever since we actually made that trade, Zynga has gone completely against us, except for today. It started to move back down into the range that allowed us to take this trade off at a profit. So we went ahead and bought back our 3 vertical call spreads, the 3-4 strike, so it's a very cheap stock. So the 3-4 strike, and we bought those back for a 16-cent debit. So made $14 overall, so almost 50% of max profit, which is again where we like to start to take off our trades when we're talking about credit spreads. So if we take a look at the chart of Zynga, you can see that really the stock just kind of went against us almost completely until today, where it just gapped lower on some pretty heavy volume. So this isn't to say that it could continue to move lower, but you'll notice that even today, the stock was all the way down at 273 and rallied back up so to close at 297. So there could be some juice in this thing where it starts to actually bounce from here. And so it might be an actually interesting candidate for something like an iron condor or a strangle. We're definitely looking into that. So we might actually make another trade just in the opposite direction here in Zynga in the next couple of days. So implied volatility is very high. That's obviously really helping the stock. But we just felt like at this point we've got a nice little profit, so we're not going to risk it and risk it for another 16 cents on this trade. All right, so let's talk about the hedge in the SPY first, and then we'll get into the vertical roll that we had in RUT. So our current position in SPY is that we're short a call spread above the market. Now that position is already in the money. So what we wanted to do here today is create a new position below the market, selling premium. Again, this is a hedge trade, so it's not a trade that we would generally make by itself. So don't try to make this trade by itself without having that call spread in there, because you don't want to make this trade in a regular market. So we wouldn't be selling a credit spread below the market in SPY because implied volatility is too low. But in this case, we need that credit spread to help hedge the position that we have. Now what we did is we actually ended up selling a little bit more of the verticals. So currently we do not have 5 verticals above the market, and I preach a lot about trying to even out those spreads if you can, because then that doesn't create any additional risk. Well, in this case, we actually sold more of these spreads, which did create additional risk to the downside. But you'll see here in a minute on the profit loss chart that I actually think this is going to be a good trade if the market does continue higher. If nothing else, it helps reduce our cost basis and reduce our overall loss should the stock continue to move higher. But we went ahead and sold 5 of the vertical SPY June, because we're still working in that month, 191, 186 put spreads for a 60-cent credit. Now you'll notice that's a pretty wide spread. It's about a $5 wide spread, and that was so that we could get a pretty decent credit, right? So premium is starting to dry up, so we need to spread out the width of our strikes here just a little bit so that we could take in a little bit more credit on this trade. Now I want to go here and just show you guys the Analyze tab without even showing you guys the stock chart of where this spread looks like right now. So it basically looks like a very, very untilted broken wing butterfly, and that's basically what we have, right? We were basically short the 190 call and the 193 call originally, and we only had 3 of those. So you notice we'll short 3 of those vertical spreads. Now with SPY trading at 194, that is already in the money, right? So at this point, if we did nothing else, and let me just kind of uncheck these 2 put spreads, if we did nothing else at expiration, this is exactly the position that we had before we actually made the hedge. So we were short this vertical call spread, and the stock was already in the money, so we were practically at max loss already and will be at max loss if the stock basically trades here and above. Now, at that point, we're going to lose about $720 on this trade if we did nothing else. So my goal here is not only to give us an opportunity to possibly make some money if the stock does move back down, but also to prevent a $720 loss. So by going in and selling the 191, the 186 put spread, we went in here and reduced our max loss down to 420. So worst case scenario, if we don't do any more adjustments, which we could continue to adjust this trade if needed, we don't do any more adjustments and we left things as is, we basically cut our loss down from 720 to 420. So we've cut it down by almost $300, which really is the essence of trading. Like I continue to say, it's not about taking up these winning trades. It's about learning how to manage some of these losing trades so that you either lose less money or make a profit in the end. And again, we're going to talk about that later on in this video with RUT, because that's a classic example of doing that tonight. But what we basically have left over in the SPYs is we have pretty much a broken wing butterfly right around 190.5. So that's really kind of our peak. From here on out, if the stock continues higher, like I said, all we've done is done nothing but reduce our overall loss. But we also leave a good opportunity that if the stock actually continues to move lower, then we have an opportunity to actually close it out at a profit if it starts to get in between the 190 and 192 range. Now you'll notice on the chart that there's a highlighted or shaded dark blue area over here, right? And a shaded dark blue area over here. Now that is the 1 standard deviation range. So what you're looking at in this light shaded area in the middle that I'm kind of highlighting right now, this is the range. There's a 68% chance that the stock or SPY closes inside this range by June expiration. So that's our 1 standard deviation range. And you'll notice that even though we took in a little bit extra risk on the bottom side of the trade, the likelihood that SPY actually gets down to that range is outside of a normal distribution. So even though we're putting up a little bit more capital in this case, we actually have a higher probability of success and a lower overall loss by making this adjustment to SPY. So like I said, this is not the end of this. We could continue to adjust this trade and add something above the market or continue to roll up our put side as well as we get closer to expiration. But right now, this is a great way to hedge this trade. It's a little bit unconventional because most people don't do this, but that's why I spend so much time going over it with you guys. All right, so the last trade that we want to talk about tonight is a combination trade. And we've done this trade before, and most recently just last week in RUT. So RUT was the original iron condor that we had going into this massive rally, right? And so the rally has moved pretty much right against our short call spread on the top side. But what we continue to say is that we're not going to adjust that side of the trade. We're just going to slowly adjust the bottom side or our put spread and roll that closer to the market over time. So as we get closer to June expiration, we're going to continue to roll that side up. This is now our third roll up in that put spread. And so every time that we do that, we're taking in more credit and more credit and more credit. Now you have to look at it this way, right? The first thing is we closed out of our current put spread, which is the the 1110 and the 11.5 put spread for a 70-cent debit. So we did pay 70 cents to close out that side of the trade. On the top side, we then reopened a put spread closer to the market at 11.30, 11.25. Now we took in a credit of $1.20. So the difference between those is the actual net credit that we took in. So we took in that net credit between $1.20 that we took in on the new position and what we paid out, or 70 cents on the old position. Now we continue to do this with the rolls, and that's what you have to do. If you're going to hedge an iron condor like this and get closer to the market, you've got to take in a credit, or else there's no point in doing it. You're just adding more risk without getting compensated for that risk. Now, for those of you who haven't been following along, I just want to kind of recap some of the trades that we've made in the RUT. Our original position was a credit overall in the whole iron condor of about $1.40. So that left our risk at pretty much a substantial $3.80 or so in risk, okay? And after that, am I doing the math right? Yeah, $1.40 and about $3.60 in risk. I'm sorry. So about $3.60 in risk going forward. So now what we've done is, after doing all of the rolls that we have, we have now accumulated an overall credit after all rolls of $320. So we've basically doubled and then some the amount of credit that we've received in this trade by just rolling and getting it closer to the market. So by doing this, we basically cut our potential loss in half and then some. So again, like just with the SPY, if nothing else, and we can't control where the market goes, it's going to go higher. If it continues to go higher, whatever the case may be, we've done nothing but just reduce our overall loss in this position by taking in more credit and more credit and more credit. And frankly speaking, we're not done here. We can continue to roll this thing closer if need be. So here's what our current position looks like in the RUT. It's a very, very narrow iron condor, but again, we still leave an opportunity to make some money if the market does continue to move lower. So the SP or the RUT is trading 11.55, clearly in the money on the call side. We know that, we understand that, but we're just going to keep rolling up this put side closer and closer and closer to the market and taking in more credit each and every time. Now you'll notice that we have still some distance between our short strike at 11.30 and our long call or our short call strike at 11.40. So we even have the opportunity, if we get another week down the road and the RUT doesn't continue to move lower, to again roll this put side up even closer to like 11.35 or even 11.40 and take in more credit. And if we do that, that's again going to just reduce our overall potential loss on this position, still leaving an opportunity to make some money. So right now we've made a pretty good adjustment close to June expiration. I think at this point we're going to be pretty much set just to wait a little bit and see if we don't get a little bit of a correction here in the next week or so. We still have about 3 weeks to go in expiration, so there's still a lot of time between now and expiration for the market to rally higher or continue to lower. So whatever the case is, we're going to leave this position on for a little bit, but at least you guys now understand the mechanics of what we're trying to do here by just continuing to roll this thing and starting with a 140 credit. And right now we're dealing with about a 320 credit overall. So you see that we have our massive credit here that's helped buffering this move higher in the RUT, even though our call spread is in the money. So as always, I hope you guys really enjoy these videos. There's a lot that we covered tonight. If you have any questions or comments, please add them right below this video in the membership area. I'll get back to all of those tonight or tomorrow before the open, and happy trading.